we're not just talking about a handful of short positions being underwater or a few hedge funds being caught offside. No, what we are witnessing is the slow unraveling of a decades-long mechanism for gold price control, a mechanism that relied on one thing more than anything else: confidence. Confidence in the system, confidence that a gold certificate equaled gold, that the vaults held what they said they did, and that central banks would never let the ship sink. But what happens when that confidence starts to erode, not in a dramatic explosion, but in a slow and persistent drip? The data from the COMEX shows this erosion clearly. As Alasdair MacLeod and other seasoned analysts have pointed out, the growing number of long positions that are not just trading contracts, but standing for delivery, reflects a subtle yet powerful shift in market sentiment. For years, traders treated COMEX gold like any other derivative, an instrument to hedge, speculate, or flip for a quick buck. But now, these long positions are transforming. They're not just asking for settlement in cash. They're saying, "Deliver me the metal." And that shift from paper to physical is a red flag. It's the canary in the coal mine for the entire paper gold pricing system. So why is this happening now? Well, think about it from the point of view of a sovereign wealth fund or a central bank not aligned with the West, maybe China, Russia, or a growing BRICS participant like Saudi Arabia. Why would they leave their gold in New York or London vaults if they're seeing the writing on the wall? If Scott Bessent is out there talking about monetizing the asset side of the U.S. balance sheet, and rumors of gold revaluation are floating around in both elite financial circles and on the pages of the Financial Times and Bloomberg, you better believe these folks are paying attention. And here's the kicker. If the U.S. Treasury is really considering using the gold on its balance sheet, valued at a comically low $42.22 per ounce, to back new 50-year sovereign wealth instruments, then they absolutely need to ensure that the gold is actually there, and they need to know they can deliver it or back those new instruments with confidence. But as we've seen, if that gold has been hypothecated, leased, swapped, or outright sold into the market decades ago, we are talking about a time bomb that no one wants to admit is ticking. This is where we have to introduce the most uncomfortable part of the conversation: the potential need for revaluation as a means of resetting the system. It sounds dramatic, but history gives us clues. Back in 1933, Roosevelt revalued gold from $20.67 to $35, a roughly 70% increase, effectively devaluing the dollar overnight. In the 1970s, we went from $35 to over $800 at the peak within a decade. Each time it was because the underlying monetary system was no longer sustainable. Now we're here again. The difference this time? The size of the debt, the global interconnectedness of the financial system, and the sheer scale of derivative exposure dwarf anything we've seen in the past. If the gold held by the U.S. Treasury is revalued to, say, $10,000 an ounce, that injects nearly $2.5 trillion into the Treasury General account without issuing a single new bond. That's politically powerful and financially strategic. But even that may not be enough. Some estimates, including from seasoned voices like James Rickards and others, suggest that a revaluation closer to $25,000 or even $50,000 may be required to truly match the monetary expansion of the last 2 decades. Could that really happen? Well, gold doesn't change. What changes is the currency it's priced in. As confidence in fiat slips, especially the dollar, gold must rise not because it's going to the moon, but because the currency measuring it is going down. Let's tie this back to the delivery system. We're not just looking at a few thousand contracts here or there. We're seeing a systemic shift where COMEX participants are now being forced to either deliver gold they don't have or scramble to buy it back at increasingly higher prices. That is what a short squeeze looks like on a macro scale. And the fact that open interest is falling while prices are rising tells you that the shorts are running, not walking out of the market. They are trying to cover before the music stops. But it's not just COMEX. The London Bullion Market Association, LBMA, has been the hub of unallocated gold trading for decades, a shadowy system where the same gold bar might be owned by multiple clients simultaneously. With Basel III NSFR net stable funding ratio rules forcing banks to account for physical gold holdings differently, basically demanding that if you're selling gold, you better have it. This leverage is drying up. That's why we're seeing gold flow out of London and into the hands of those who want to hold it, not lease it. Meanwhile, ETFs like GLD are bleeding inventory. On paper, they say it's because of profit-taking. But more likely, insiders, those with the ability to redeem shares for metal, are quietly pulling the plug and getting physical out while they can. Retail investors? They're still asleep, but smart money isn't. This all leads to one obvious question. What happens next? Well, there are a few scenarios, and none of them are benign. One possibility is a stealth revaluation, a slow grind higher where gold gradually makes its way to $5,000 or more over the next few years, just fast enough to outrun inflation, but slow enough not to panic the system. Another possibility is the Friday night special, a sudden revaluation over a weekend, where the government announces a new gold backing at $10,000 or more, catching the world off guard and immediately restoring the balance sheet of the United States. Or perhaps the most likely scenario is one where the revaluation happens, not because policymakers choose it, but because the market forces it. We're already halfway there. The institutions that matter are accumulating physical. The delivery queues are growing. The system is creaking. The longer we pretend everything is fine, the more dramatic the adjustment will be. Our viewers need to understand that this isn't about making a quick buck. It's about understanding what money actually is and what it isn't. Gold and silver have stood the test of time because they are not promises. They are not someone else's liability. They are real, tangible, immutable. And when the world wakes up to the fact that fiat currencies are not, they will rush to the exits, and by then, the gates may already be closed. So don't wait for the headlines. Don't wait for CNN to tell you gold is soaring. By the time that happens, the move will already be over. Look at what the smart money's doing. Look at the central banks. Look at the insiders who are redeeming their paper for metal, and look at the premiums, or lack thereof, in the retail market. That's the calm before the storm. We are on the cusp of a historic monetary transition. The collapse of confidence in fiat currencies is unfolding quietly, and gold is re-emerging as the anchor to restore sanity to a broken system. If you haven't positioned yourself yet, now is the time, because when that Monday morning comes and gold is suddenly priced at $5,000, $10,000 or more, you won't be able to buy it. You'll be offered a receipt, a promise, a digital token that says gold, but can't be redeemed. Real gold will vanish into private vaults and sovereign treasuries, while the public is left wondering what just happened. Don't be in the dark when the lights go out. Own the metal, hold it yourself, and sleep soundly knowing that when the music stops, you'll still have a chair.